Welcome to another episode of Folico Quant. Since our reshuffle last week, where we're bringing you new content, new shows, this is going to be our first inaugural episode of Cinerai Quant. We did do on August 19th a form of this, but today is going to be our first dedicated show to it. Now, what we do during Cinerai Quant is we take an interesting phenomenon, trend, or question, and we go really deep with the data. So this is the kind of the data science hour, if you will. And then Tyler is going to be here to add color commentary and how we would use this data thinking in everyday practice in portfolios. Again, I always lead off with this. We are not financial advisors. Invest responsibly, invest knowing your own risk tolerances, and so on and so forth. I am a former data science careerist, not former, current data science careerist. Tyler is the former hedge fund PM, current Cinerai head of research. So today I want to dive right into the meat of what we're going to be talking about because I'm excited. I don't know if you can tell that about me right now, but I'm excited to talk through this. We've been looking at the S&P 500 pretty extensively, and we've been wondering, when should you be risk on and when should you be risk off? So we've started over the past few weeks building some models to predict the S&P 500. Now, some interesting things came out of that. And let me just let the cat out of the bag and show you what's going on here. So I'll pull up my screen. And what we have here is two lines. The blue line is SPY, and the purple or dark blue line, depending on how you look at it, dress is blue, dress is white. There's going to be those debates all day long, right? That purple line is our prediction of where SPY would be. Now, where this lines up is on this day. So if you see my screen, March 23rd, 2018, SPY is at 264.17. Our prediction 20 days prior to March 23rd, so March 3rd, our prediction was that SPY would be at 273.06. And so I want to make sure we're clear that this is going to be misaligned a little bit. Those lines are put together right at where the truth actually is, which is why this purple line, which is our prediction, is always going to be 20 days further than the light blue line. Now, the whole goal here is to see how accurately can we predict what the future of SPY is going to be. But I want to point something out. So one of the biggest criticisms of data science and machine learning, and this is a good criticism, is that if you give me all the data in the world, I can almost perfectly predict what will happen yesterday. Models work perfectly on understanding the past, but there's always going to be exogenous events happening in the future, things that we can't predict or understand. Now, if you think about what Foliko or Cinerai's models have, we're ingesting data from around the world, perspectives across many, many different walks of life. We're bringing in journalists that focus on politics, articles that focus on business, articles that focus on finance and markets, and we have model upon model upon model digesting all of these in a reasonable way. And then with those, we produce our health scores. Now, one of the key factors in this S&P 500 prediction model is integrating those health scores. In other words, we're integrating the view of the world for what's happening. So if we look at what's going on here, there's an interesting way that you can bend what these predictions mean. So let's zoom in on a particular date. Let's zoom in on 2018. So if you see this light blue line, it's SPY, 273.34, and our prediction, 261.87. What's interesting about comparing it this way is that we have here an understanding that 20 days ago, with all the information and data of the world, all the predictions of the financial sector, political understanding, all of that, right? What everyone is saying, if you mix that in and understand it well, the market is beating where everyone thought it would be at this time. In other words, given all the data and information that we had 20 days ago, the world as it actually is better off than we actually estimated. So for me as a data scientist, this means, shoot, I need more data. I called something a little bit wrong here. Data scientists immediately look at error and we say, well, I want to fix and reduce that error. I don't care about what the model says versus what it is now. All I want is the truth versus the prediction to be as small as possible, and that's it. And one of the ways we measure error, by the way, you need a good baseline model. Is if your model can't beat randomness, then you've got a bad model. So that's always something that we bring in to bear. And yes, we have beaten that, and so we have several different metrics that we like to exceed. But still, the fact remains, I want my future prediction to reduce error versus reality as much as possible. And so myself, and by the way, I really want to be clear on this. We have another data scientist working with us. He's asked to be anonymous for now. Eventually, I'd love to introduce him to the world. He's just an absolutely fantastic person, but he's been working with us for several months. He made a beautiful model in this. So eventually, you're going to get the credit in the name of this Picasso that has built this model. He truly did wonderful work. This one was not me. I wish it was, but it's not. But we were showing this model to Tyler, and we said, all right, so far we've got something good, but we're looking to integrate new data, new ways of looking at things. And Tyler came out with an interesting observation that was contrary to every molecule of data scientist within me. Tyler,
yeah,
what did you see when you see this graph?
So I'm if you know the midwit meme rather, I'm the left side of that. You guys did some very complex data science and came out with the results. And then I said, ooh, look what happens when the lines cross, right? So to be clear, I am bringing absolutely nothing to the table here, but check this out. So as I always talk about, I come from a technical background. So one of the things I look at is, okay, so divergences, convergences, moving average crosses, things like that to try to provide some context into my risk taking. So if you notice, if you hold our purple predictions 20 days ahead line as the trigger line and SPY as the independent, you can just trade those crosses. And you've done quite well. It's sidestepped some absolute, near decapitations for indices in general. So I think this is very cool. This is one of the things I'm here for, is to take this data and to make it work. So this is one of the things that we'll be sharing with you. Think of it as a maybe a 50-day, 200-day moving average cross. That's almost offensive because of the high level of data science that went into this. But on a very small level, when cross trade, right? It's about as simple as that. That's our alternative hypothesis here, is that we have created a entry exit model into the S&P. And it's done quite well if you look back. So what we're excited to do is now we'll look forward. Now when it crosses, we'll trade it. We'll tell you about the P&L. We'll tell you, really the specs of the trade, how much of a drawdown we had to take before we realized any positive P&L, things like that. And I think this is really interesting. I think this is what Folico data does best. Once you take it and gross it up into a full market indicator, that's when special things start to happen. And that's what the companies who approach us, I think, will be able to take this and come up with their own conclusions and things, because this was pulled directly out of our data. This isn't an additional data set, anything like that. This is what we already had. And, the boys in the back were able to gross it up and, really do a great job. We'll have him on the show because I think, he just has, fascinating, inputs on this stuff. So when he's ready to come hang out, we will definitely have him come hang out. I've learned a lot already. So we'll definitely do that. But I mean, look at this. This is pretty interesting. And if we can,
I want to bring the audience along real quick, Tyler. The key observation that you made, and let's really put a point on this, is that trade the crosses. So in other words, what you noticed, as you were telling me earlier, was when this blue line shoots up past the purple line, risk on. Yeah, I mean, you could almost just buy the S&P.
That's exactly what we're going to do. We're going to trade indices off this thing. We're not even going to mess with single names. We're going to So this is SPY. We'll swap in the Qs, which is the NASDAQ tech index, and then we'll do small caps, and maybe we'll have 3 flavors of this model.
Well, let's review a few situations. Like, let's actually go through it real quick. So blue line shooting up past the purple, May 4th, 2018, you would have bought at 261, shot back down, you would have sold at 269, profit made right there. You would have bought back in, sold 287, profit made right there. Look at some of the downfall that you would miss out on, which is what you want to do, right? So this is, we're talking long only. You could go short and make profit on the downside too, right? And I'm going to show some data for that in a second.
That's the most interesting thing, is using this strategy as a long only. You're up 2% this year, which may not seem like much, but you've sidestepped some of the nastiest drawdowns in the last decade. So I'd call that a win.
SPY's down 30% and you're up 2.
Right. That's you've done your job. You have protected your chips in your chair, which is really all that matters at the end of the day.
Well, and look what happens. October of 2018, you would have been risk off. You would have said, out. I'm out of the market. If you were long only, or if you would have shorted, you would be making profit on this. But just for simplicity on the show, we're going to go long only for a little bit here. You would have gotten rid of everything at 287, and you're selling. Yeah, you could have sold at a higher peak, 292. You're selling at 287. That's the cost of knowing better. That is a pretty straightforward cost, I would say, because by the time we're looking at getting back in 273, you've avoided that downside. And then look at this. Right at the end of 2018, you would have missed that entire 2018 downfall right there. Let's see where else. Let's take a look at COVID. You didn't sell quite at the peak, but come over here to April 24th, you would have been getting out of the market. And look at all of that downside you would have missed. And then conversely, once the blue line recovers there, and you'll see some ambiguity where it's really kind of going in line and trussing up a little bit there. But then you start enjoying all of the upside from mid to 2020 to mid 2021. And finally, it flips right over here in January of 2022, risk off. Now, we have 5 different versions. Oh, go ahead.
What's really interesting to me too is look at some of these sidestep maneuvers to stay long on the way up. That's another thing that's interesting, is we have a bunch of dips where it, never quite crosses. So in terms of a systematic approach, you'd be able to stay long. So you didn't, okay, maybe you bailed right. Go back a little, up to the right, where they come together.
Right there.
The next one, yes. So that looks like, I can't see it that close, but that looks like potentially out and back in over a 2-day span. But what's important here to me is you maintain your long position. That's what's important, is if you buy a long and you dump it 50% on the way to the target, that's good, but that's not optimal. This allowed us to stay in pretty much the whole bull market, which I think is important, because the worst thing to lose is your position. So
absolutely. The more we looked at this, the more we realized this is a winner right here. Now, we have 5 different versions of this, and we are going to be looking at all 5 pretty consistently. This is data that we've been really discovering and exploring for the past few days, by the way. We're going to be finding more insights all the time. We're just discovering which one is better at which situation. But we do have 5 different flavors, and you're going to see us referencing this in shows going forward pretty consistently, because this is a permanent, daily updated dashboard right here. That one data scientist that we referenced earlier, we want to write him a thank you note as soon as we find out who he is, right? But we have this 5-day moving average. So this is a 20-day prediction, 5-day moving average. This ends up getting you the highest return since March 2018. Okay. It ends up also being a very consistent return. I mean, if we're talking about a Sharpe ratio on this is going to deliver a very nice Sharpe ratio. The line upward is almost flat. If we're talking drawdown, your largest draw, we'll look at this in a second. I'm not going to spend time on that. Then we have a 5-day prediction. So this is just that raw 5-day prediction. You end up doing a lot more trades this way. So if you want to be a more active trader, this might be the better way for you to go. But your return ends up being slightly lower than the 20-day, 5-day MA. So it can be informative, but if you just want to use this to make money, this might not be the model for you. You get a quicker signal, but the confidence is a little bit lower. And then we have 5-day prediction with the 5-day MA. And then here's just some magic where we're overlaying them all together. Tyler, you mentioned to me that you're going to be going deeper into this, and you can start taking a look at individual lines here and how they interact and things like that. So this is going to be a chart that we reference often in our regular Foliko live shows to understand market volatility, where the market is going, whether or not it's a risk-on, risk-off environment, and things like that. And we feel very confident that this is going to be a good predictor leading us forward, especially as market turmoil is really in question. So in future episodes, I want to talk to you just more specifically about how you can use the things that we say, given this information that you're going to start getting on a regular basis. When we're saying earnings and we have a prediction, so earnings will be up, earnings will be down. If it's a risk-on environment, perhaps you should be slightly tilting towards the long options that we suggest, right? Tyler, am I saying this right? This is from a data perspective.
Right.
But from a trading perspective, I want you to correct me if I'm saying something wrong here. None of this is rehearsed. We're live always. But if it's a risk off or the market is down environment on those earnings calls, maybe take a little bit of a doubt towards the calls and more favorable towards the puts.
Yes, this is a way to inform you if you are trading with or against the trend. That is essentially the question, is if you are looking for positive earnings in a negative, downtrending risk off kind of context, yes, on the margin, I would temper my expectations because everything's a bit soggy. On the other hand, if you're looking for earnings not to beat and we are in positive risk context, then maybe you shouldn't be surprised if what otherwise is a bad report ends up plus 15, plus 20, just because of that's the current risk backdrop. So I think that's the most important thing about what we're doing here is, one, we're going to try to make this a systematic, just trading one factor model, right? Is the line crossing, buy, sell, that's it. But on top of that, we're going to use this to inform what the context for risk is, risk on, risk off, and then adjust portfolios appropriately.
Great. Quick comments. Troy Ed, viewer coming in. Congratulations on releasing Folico Snapshots. Love it a lot. So we released a new product yesterday called Folico Snapshots or Foliko Lite. These are basically free views of company health indicators. We released it yesterday around, right around our show, so 11 Eastern. Absolutely incredible. I had high hopes. But we've had hundreds of people pouring in, taking a look at these, getting value out of them. Tesla was a really big winner yesterday. And today, I think a lot of people are enjoying the view that came out of Tesla. So absolutely, we're going to be providing links to Folico Snapshots in every show that we do. You'll find them in the description below right after we're done recording live here today. I'm going to put a few snapshots in there for everyone to enjoy, take a look at what's happening in the market. And what this is all this data that we're talking about, that we're showing off here. It's not just stuff that we get to enjoy and play around with, and hopefully we mention what you want to see in the show. Now you have the ability to go in and see any of the companies on our coverage list and go deep with the data and then come back and educate us. Tell us what we're missing. Tell us what we should be looking at. Ask questions. Interact. Troy Ed comes in and doubles down. Good feelings and love here. Appreciate it, Troy Ed. Data science feels like magic, and you guys are magicians. Love your work at Foliko. Thank you, buddy. It's great to have you along with us. We enjoy and adore all of our audience members. This wouldn't be possible or fun without you coming along. So thank you. All right, I want to show some results from data that I've been cooking up here in the back kitchen. This gets deep a little bit quickly. We don't have the time to go as deep as I would like, but what we have here is from those 5 different views. And in fact, there's 6 here because we have a rolling 10 on the 20 and the 5. But on the different views that you just saw in that Power BI dashboard that we will be showing occasionally. Here's the results or returns that you would be getting. Now, the x-axis, I need to be clear here, is a per trade. So I could turn this into a date and all these lines would line up, but it wouldn't give you a good view as to how each trade is doing. So there's different ways you can splice, cut up this data, but essentially this gives you a very quick, rough view of what the return is for each of these. The highest return, it's a mix-up between the Preds 5 rolling 10 and the Preds 5 rolling 5.
So you haven't really explained exactly how we derive those lines. Will you do that now?
Yeah.
And just
absolutely.
in terms of what is Preds, like what did you put into that to come up with that?
Always appreciate you talking me off the ledge here. Yeah, so I can go in and talk a little bit deeper because my mind is in the data so often, it's hard for me to visualize coming at this for the first time. So I appreciate it, Tyler. Thank you. So what we've done here is we have SPY since 2018. And so you can see what's going on there. And we have the lines just like we were showing here. And the thought is, well, what if we did act on trading every one of the crosses? And in this is actually not going to be long only. This is going to be both short and long. And so if you just plot out our data, which our data is coming out and looking like this. We're pretty open with what our data sets are here because we want you to be able to get as much value as you possibly can. And so what we have here is a whole bunch of variables coming in to understand what's going on. And finally, we have predictions on 5 days from now, predictions on 20 days from now. And we've lined them up so that we're lining it up for, here's the date that we predicted today is now March 23rd. And so what is the S&P 500 price for today, March 23rd? And we can see exactly what were our expectations for today versus what is reality. And that's how we're comparing this prediction 20 days out, prediction 5 days out. So if you look at where the cross is, what you're actually saying is, where was our prediction 20 days ago? Where was our prediction 5 days ago? And these are market days, by the way. So 20 days is almost a month. 5 days is a week. Make sense?
Yep.
The way I'm walking through this? Okay. Then we end up with a data frame that looks like this. So here we have just a whole bunch of helper columns to say where the intersection is, but essentially what is the action? Is it going to be a buy or a sell? And then what is the purchase price? And then what is that eventual resolution price? And we can extract what is the profit from that trade. Okay, very simplistic. There's no additional intelligence or information coming to this except for when does this cross, when should I trade, and how much profit or loss did I make from that trade? Does that make sense?
Yes. Do you want to talk about at all how we took the health factors and actually turned it into this prediction?
Yeah, so we have a whole bunch of data. Now, our prediction for the S&P 500 is where we do get a little bit proprietary because this is data streams that we do sell out to other institutions, hedge funds, and things like that, right? So we can show you what those predictions are, but how we make them is a little bit of our competitive edge. But we are including in a lot of time series methodology. We're including in those health scores. We're including a whole bunch of feature engineering, they call it. So when you take one health score and you multiply another health score and you multiply it by this other market indicator, and that produces a different kind of view on the market. We're doing that kind of feature munging and engineering. But at the end of the day, what we're doing is layering on some machine learning techniques on top of this data set to take a look at all that data and say, given everything I know about the current state of the world and where it has been and baselines and trends and things like this, here's what the computer, predict will happen in 20 trading days from now. Does that answer the question, Tyler?
Yeah, I just wanted you to kind of provide the framework by which we were getting here. So okay. any of the other our B2B clients who are watching or people on the institutional side start to understand, from a more advanced framework. That's all.
Gotcha. Well, and so you can see the results coming out here. As to where they end up, you end up on market beating, especially on the 5 day predictions with rolling. And look at the smoothness of some of these lines. So if we look at orange is Preds 5 rolling 10 mean. So this is our P&L. So we can do and what we don't have is a return per day, right? But look at the smoothness of that line going to the upside. You've taken all that volatility of the market and you basically extracted it right out. You almost have an entirely smooth line going straight up. So this represents about 65 different trades that would get you up to this level of profitability. But we're looking at, we don't plot. A 55.5% return from March 2018 to now.
With very limited drawdown. And that's what's important is, most portfolio managers, if they draw down 20% at any point, the compliance comes and cleans out the desk, right? So the most important thing is you got to maintain chips in a chair. You have to have a job to come back to tomorrow. And if you were a PM who had traded this, you'd have a job to come back to tomorrow. No, did you capture all 100% upside in the NASDAQ? Probably not. But I think, that's, especially on a risk adjusted basis, that's something. I mean, that's one, two, three really nasty drawdowns to speak of over 3 years, which, is a pretty impressive thing given 2018, very tricky market, 2019, very tricky market. The beginning of 2020 was a tricky market, currently very, the trickiest market. So I think that's something, positive enough that we're going to start putting real money to work behind that.
Absolutely. And imagine if you take this model and line up some of the power of sophisticated trading models on top of it, and it does become your risk on, risk off model, right? Look at how we're doing in 2022. This last little tail represents 2022. Phenomenal.
Right.
Everyone else is in turmoil. We're doing great. So this is something exciting. It's exciting to the point that we are going to make the commitment to be bringing you this data and these numbers on a regular basis. We love questions. I hope that I was explaining some of the data science mechanisms coming into this. I want to be open so that you can make as best use of this data as possible. So if you have questions, put them in the comment section below. We do look at them. We will get back to you and help you understand exactly what's going on here. And if it's a great question, we're going to bring it on and address it in a future episode of the show. So thank you, everyone, for joining us. We do need to get running. AI swing, we got one question coming up here. Speaking of questions, AI powered swing trader. Thanks for joining us today, by the way. How many trades did that include? Well, it depends on the model. So each of the model has more or less cross points.
How about the performance of I think he might mean the one that you were showing performance for just now that was up 55%. You said it took 65 trades to get there?
65, exactly.
Okay. So 65.
Yep. And so depending on the model, there could be more or less the 20-day. Obviously, there's going to be far fewer trades, but we'll always be here to update. So thank you, everyone, for joining us. We're looking forward to future episodes. I hope you have a great weekend. We'll be back here next Monday for our 2-episode day. That's going to be our earnings report. No matter how many companies are releasing earnings, we'll still be here. So it might be shorter, longer episode, depends on that. But also we will be back with a Foliko Live to give market analysis and updates. Thank you, everyone. Please enjoy the Folico Light snapshots that you have available for free. Again, in the comment section below. If you like this episode, please support us by liking, subscribing, commenting, and just telling your friends about us. Thank you all. Have a great weekend.